Hey, I'm Mark Milstein, Faculty Director of the Center for Sustainable Global Enterprise at the S.C. Johnson College of Business at Cornell University. The Center for Sustainable Global Enterprise is actually celebrating its 20th anniversary this year, during which time we've been conducting applied research, teaching, and engagement that's focused on the strategic business growth opportunities that come from addressing the world's most challenging social and environmental problems, such as climate change, ecosystem degradation, economic inequality, and poverty. We offer a number of programs, events, and activities for graduate students as part of one of the leading MBA programs that emphasizes sustainability. And we also have online and certificate programs in sustainable business, as well as sustainable tourism destination management, both of which are available through eCornell if you're interested in exploring those. We're so glad that you've joined us for today's session, Reimagining Venture Capital for Sustainability. How can we genuinely propel entrepreneurship? Some of you may be familiar with this, but this is one of a series of webinars that we've organized in collaboration with our partners, Deanne Caldeny, who is with the CSG Group, and Renee Bonamy, who's an alum of our program, who is with Bonamy Desenvolvimento Empresarial. I hope I did that right for you, Renee, for making today's conversation a reality. And like all of you, I'm looking forward to hearing the discussion. And with that, I'm going to turn it over to Renee.
Thank you, Mark, and good afternoon, everyone. It's a pleasure to host this keynote together with Mark Milstein from the Center of Sustainable Global Enterprise at Cornell Johnson and Deanne Caldeny from the CSG Group. During my time at Cornell pursuing my MBA and throughout my career, my purpose has always been to connect entrepreneurship, innovation, and sustainability, and especially discover ways to improve investment into sustainable businesses. Today, we'll have a great discussion with outstanding panelists on how we can find ways to improve the venture capital industry for sustainability. I want to personally thank the center, the moderator, Joe, and the panelists, Megan and Danilo, and the eCornell team, who helped us enormously in putting this keynote together. Thank you all for attending the event. I hope you enjoy it. Deanne will continue with the introductions.
Good afternoon, and welcome to our 8th presentation with Cornell's S.C. Johnson Business School, Center for Sustainable Global Enterprise, and with Renee Bonomi. We're thrilled that Mark Milstein is among us as co-sponsor of the center and clinical professor of management. Over the past 4 years, I became fascinated by innovators and entrepreneurs, especially those who have a mission to improve the lives of their fellow human beings or who work on solutions to mitigate the climate crisis. Delving into how they move their ideas from the initial stage to an actual business is when I realized I founded the Capitalism and Social Good Group as a collaborative to help founders get the capital they need. And I realized that to be impactful, it's important to fully understand what are the processes that can best assist entrepreneurs to reach their goals of building a business. 3 years ago, I had the good fortune of meeting Joe Milam, founder of AngelSpan, who has been researching the venture capital world for 20 years. He will share his many observations while having our esteemed panelists give us a glimpse of this world based on their respective involvement. Our goal is to improve results for both founders and investors with our collaboration with AngelSpan and Cornell. So many thanks to each speaker for your participation, and I appreciate that you all have taken the time to join us this afternoon. We hope you'll enjoy the presentation. Thank you. Joe, it's all you.
Thank you, Deanne. This is a kudos to Cornell, because this is as Deanne spoke to, it's been something that's been near and dear to my heart for a long time. In improving and fixing how we fund innovation, with the impact being, as Deanne pointed out, benefiting both entrepreneurs and having a more efficient path to funding, regardless of who you are, where you live, what your business model is. That's clearly not the case today. But equally as important is to mobilize more capital into the entrepreneurial ecosystem from a more diverse appetite of investors. There is a tremendous amount of latent capital that's sitting on the sidelines that would be very much interested in supporting entrepreneurship, where both their quantitative objectives, they don't want to be the dumb money at the table. They don't want to look stupid by allocating capital to something that isn't popular or in vogue or part of what the media is all touting that the purported smart money is investing in. But they also want their qualitative agendas served. Having been run a multifamily office and been a philanthropy consultant for 20 plus years, I've seen firsthand how the power of qualitative motivations, what investing in the private investing world calls impact investing. I think this is the great opportunity to mobilize far more patient money into entrepreneurial ecosystems around the country, but it requires conversations like this. The good news is the venture industry is coming under serious examination, I believe, for the first time in my career of studying it myself. There's been a number of very prominent folks that have come out and spoken about the need for the venture industry to innovate. In fact, the man who teaches entrepreneurship at Harvard's Business School right now, Tom Nicholas, he wrote what I think is the consummate modern history book on the venture industry. And for those that are interested in doing a little bit of research, it's called VC, An American History. It's a terrific book. On page 311, he writes, "It's ironic that the industry that purports to fund innovation largely hasn't innovated." And so that's why we're here today, is to talk about the opportunities to innovate in how we fund innovation so that we can have the outcomes Dion spoke to in supporting a more sustainable venture ecosystem. We've got, again, two terrific and diverse backgrounds in our two other panelists. Megan, why don't you go first, introduce yourself and why this is a topic that's important to you?
Absolutely. So thanks so much for having me. By way of background, I'm Megan Cross. I'm a partner at Amplify Her Ventures, a fund that my business partner and I launched about 6 years ago with the whole intention of supporting diverse teams and women entrepreneurs. We saw an opportunity to do so when really you look at the stats that honestly continue to need improvement, where 2% of women receive, 2% of female founders receive venture capital dollars, and yet those teams tend to outperform their peers by a degree of about 60%. So the opportunity to invest in more diverse teams is very apparent. I've been investing for a bit over a decade now. My previous firm was Red Bear Angels, which is the Cornell alumni investment firm. I was brought on by a group of board of trustees and alumni investors to build that firm from the ground up. And that was around the time of Cornell Tech being built on Roosevelt Island here in New York. And there was just always opportunity to invest in Cornell alums, research, and more. And really, though, how I got to investing was through startup operating. I had several years of experience prior to that building companies within the tech ecosystem here in New York and in Silicon Valley.
Super. Danilo.
Thank you so much. Thank you so much, Joe. Thank everyone for having me here. I'm very happy to participate in this discussion. I fully agree that it is a very current, hot topic. If you little background on myself, I'm originally from Italy. I'm a corporate lawyer, business advisor. I've been practicing in continental Europe and in London, and now for about 10 years here in New York. I consider myself lucky enough to observe the VC war from the legal lenses, and being fortunate to be at firms that had the privilege to work with VC funds, then private clients investing directly or with other similarly situated investors in VC opportunities, and then also to reflect a bit as kind of the overall market industry. My academic training comes from University of Oxford. I have a legal degree, law degree, and an MBA from Sahib Business School. So I view and consider the VC markets from legal and business perspective. Very happy to be in this conversation today.
That's terrific. Clearly, we've got several perspectives looking in on and sort of lifting the hood underneath the venture model. And as Tom Nicholas says, the venture industry largely hasn't innovated since the first fund was launched in 1959. I think that's really a key point to sort of isolate and tear apart first and examine a little bit and discuss is why do you think the industry hasn't innovated? Where the venture fund structure is largely the same. And again, if you read Tom's book, it was brilliant in speaking to just how the industry sort of sprung out organically. It wasn't something where there was some serious thinking says, we need to do this. It was the result of the Small Business Investment Act, 1958, to spur and fund the innovation that came out of the R&D from World War II. But the industry hasn't largely innovated. The venture model is still largely the same. If we had the same thing happening in cars or refrigerators or anything else, people would have been up in arms a long time ago. Danilo, I'll start with you. Why do you think it hasn't changed? Let's address that first.
I think that there is a lot to discuss this. I would like to add some qualifying, largely innovated. I believe that, maybe here I'll start with more a contrarian position. I would say that in the overall industry and in different verticals and transactions, we do see, I think, significant innovations in terms of players that come into invest and deals that be terms of the transaction that being structured following the different market trends. So overall I think probably one reason that has kept the VC industry largely unchanged is also because the legislator has been more on the, let's say, fair approach, where we have a VC industry that has claimed that there should be, in the arena of the private, firms, investment firms. And now we have seen over the last, year or so, more the SEC take a different stance and all this has been following. So maybe I'll stop here from there, and happy to dig further and add some more color to all this.
Megan?
Yeah, I'll add to that. On the regulatory note, I think that venture capital is an asset class that celebrates simplicity for a very good reason, right? When you're investing at the earliest stage in a company, literally everything is going to change and evolve in the company. There is so much friction that is about to happen to the company that the best deals are done when the term sheet is plain vanilla market standard NVCA preferred terms, right? Just like the simplest VC founder dynamic is the age-old 2 and 20 VC model, investing in the same type of format that VCs have always invested in founders, because there is so much other stickiness to be had in the venture path for a company that if the infrastructure of the investment firm and the processes around the legalese of it are kept standard, it at least keeps everyone aligned and focused on just making that pie bigger. So I think that's why a lot of the 2 and 20 structure has been more or less consistent over the past several decades. That said, I'm constantly trying to challenge it and trying to figure out ways where we can provide liquidity to early stage companies in a way that doesn't necessarily expect them to grow in the same exact path as every other venture business. Not every successful business that requires outside financing is a venture business. right? So there have been some funds here and there that have introduced different types of term sheets with combinations of debt and equity financing, for example. None have really taken off yet, but there is a lot of opportunity to explore there. And I think we're going to see that as more and more companies stay private longer. I'll say one more thing and then I'll pause. I think it's also important to keep in mind really what we're after, which is returning liquidity to our limited partners. And one thing that has evolved in that sense for the venture landscape are all of the opportunities to do so for seed stage companies that are now illiquid longer than they've really been in recent history. Right, as companies stay private 10 plus years as opposed to exiting in 5 to 7 years, how do we return the liquidity to our LPs? For one way that we're seeing become more popular now is secondaries. Secondaries really, they're so popular now, but secondary sales really weren't that common 3 years ago, 4 years ago, let's say. So while the core of venture has not evolved significantly, features have been introduced and explored and exercised more in order to evolve it and introduce that liquidity and introduce the friendliness to the founders.
Yeah, Megan, you raise a couple of important points, and I'd like to just put a pin in them. One is the notion of standards. I completely agree with you. If you really take a look, and this is I'm going to guess a pretty academic audience we're speaking to, the whole notion of efficient markets or the efficient flow of information, if you will, so that you can have efficient flow of capital. Standards are absolutely necessary. That's just fundamental tenets of efficient market and information theory. You need to have standards and consistency. One of the things that I find so interesting is in the research that's been done at INSEAD. Danilo, is that where you went?
Yes. Yep.
Yeah. Claudia Zeitzberger has done some great work at INSEAD. There's been some other work done by other academic institutions on almost taking a whiteboard approach to the venture fund model itself, the fund structure. You speak very appropriately about the term sheet.
And Joe, sorry, I think you meant SEAD. No. So in SEAD, no, I was in Oxford, so the SEAD business group right now. Sorry.
Oh, I'm sorry. Yeah. Okay. Sorry. But yeah, she's at INSEAD out of Singapore, but she's grabbed grad students and done some of the best work on, again, approaching the venture asset class as just that. Just like when we look at the public markets as a guidepost, what happened in the evolution of how money was managed and investing was availed to a broader and broader scope of investors as innovation entered into the public market investment arena. You know, one of the big inventions that was fought tooth and nail by the historical participants was the notion of index funds. Just structural index funds where their active management, where the management fees were purportedly to hire talent that could outperform and deliver good risk-adjusted returns, and yet the data spoke otherwise. And so there was an evolution into index funds, which is where about roughly 2/3 of money is managed today for that exact reason. And then the active management strategies in the public markets are considered peripheral, or they're called satellite strategies. Small cap growth, large cap value, fill in the blank. The venture industry needs to go through a similar renaissance of innovation for the very reasons you speak to, Megan. One is just liquidity. Entrepreneurship is evolving, and as more capital is availed into startups, they're going to stay private longer because going public was principally and originally a source to get access to capital to broader shareholders. And we're seeing obviously the evolution of crowdfunding as a possible source. To retail principally, maybe non-retail investors. But secondary markets is another direction that I think is going to get, in fact, I'm certain of it. There's a lot of players like the BlackRocks of the world building the piping for a more robust, like a NASDAQ equivalent, where pricing and structures and liquidity structures are actually going to make it look, again, more like the public markets. So that's terrific thinking. Another thing that to me is lacking is the standardization of research processes. Okay. And again, I always go back to the public markets as a parallel. One of the things that entrepreneurs complain about is the moving targets of due diligence milestones. You know, they hear from one investor, this is what's important to us.
Mhm.
And another investor says, this is what's important to us. And so it's like a moving target.
Mhm.
I'd love to both of you to address that concept, and to what degree might there be an opportunity to have a little bit more, if not standard, at least something that's aggregated around some degree of consensus around a broader list, but somewhat shortened from today, list of due diligence criteria that might even be appropriate for seed stage, and then they can become moving targets as the companies mature into later stage funding rounds. So Megan, why don't you go first on that one?
Yeah, sure. So I think the moving target piece is, I know it's frustrating for founders. However, it is representative of a strive to have an efficient market, right? So when we talk to founders, we and the founders will often say, like, let's let the market decide on the valuation of the company, on the benchmark seed. And what that really means is the lead investor coming in, it has, how do I say this? If somebody is willing to pay for something at a certain price point and nobody else is willing to pay that price point, maybe that's the price. So basically, what I will say to this is kind of a converse answer to the previous question, which is VC has evolved a lot in one way in particular, and that is there are so many players. Every fund has its own personality. Every fund's partnership has their own dynamic, what they look for, what they prioritize, what they focus on. So the phrase, what we like to see at XYZ stage, that really is something that they're looking for, and it will fit with their portfolio. And it may or may not fit with that company's benchmarks or KPIs at the time of conversation. So how I work with founders in our portfolio when they're raising subsequent rounds is I'll say, look, here's what I've seen other VCs look for at this stage, but that's not everyone. And it evolves as even the potential exit market evolves, as well as many other environmental factors. What's important is that you, as the founder, think about, do you have 24 months of runway? If not, how can you get 24 months of runway and continue to work towards the North Star that you've been working towards this whole time? And when founders start to evolve that in order to cater to trends they're seeing in the market or what other investors are looking for, that's when the boat gets rocky.
Thank you, Megan. Danilo, thoughts?
I fully agree with you, Joe, the importance of standardization. Definitely that is a key element of, strong element in the market. I think we should touch on the importance of, technology and all the disruption that technology is bringing toward the end. Megan was mentioning, the secondaries coming, into the marketplace. And we now have a French company being able to execute secondaries completely, through technology without, reducing at a minimum, all the administrative costs and the execution process. All of this, I think that without a thing, objectively brings some added value to the founders and investors. We are creating liquidity. We are making this market more and more accessible. I then consider that while it is definitely very important to aim towards standardization, we want to keep a very healthy tension between standardization and information arbitrage. That is where an investor and a founder are going to have a very constructive, value-generating negotiation conversation to come to the right deal. I think that this has been the key element of the VC market, and being able to have a meeting between founders and VC founders. So I think that technology and the importance of expanding the the platform of potential investors. These are what two of the key innovations that we've seen in the VC market.
I'm gonna
Yeah,
throw out some
I
provocative. Oh, go ahead, Megan. Do you have
Yeah,
some
I
thoughts?
go back and forth whether I think standardization of expectations in terms of KPIs for every stage is really necessary, given every company is so different, and every investment firm is looking for something different as mandated by what's been agreed upon between them and the LPs to which they owe a fiduciary responsibility.
Well, you raise an important point, which is where I was leading to. Again, as a money manager in the public markets for 30 years, 20 running at the firm myself. We have the SEC coming through every 5 years, auditing our back office and making sure we're adhering to all the SEC required things. The industry itself has a standard performance computation called GIPS, which is if you're a consumer of investment services, whether it's a mutual fund or a money manager like we were, you could have confidence that you were comparing apples to apples.
Mm-hmm.
None of that is true in the venture world. In fact, the venture world is the last financial services industry where there is a fiduciary role and responsibility, yet there is zero professional standards required to become a VC. There's no training requirements. There's no body of knowledge that's required to study, so you could actually live up to your fiduciary responsibilities in a more traditional or classic way.
Mm-hmm.
That's something that very few people realize. As I like to say, hairdressers have more professional rigor they have to adhere to call themselves a licensed beautician. But the venture industry itself has zero professional barriers to entry or standards of professional conduct. The NVCA has always been a lobbying organization, not a professional standards and practices organization. In a spirit of, as we're talking about it, the goal is how can we innovate on the venture model? Do you have any thoughts on more professional standards, thinking from the top down? Do you think that would have a role? If so, what might that look like? If not, why not? Danilo, why don't you go first? You had to go through law school and get trained and the bar exams, etc., before you could give somebody else advice.
That's right. So I went through law schools and all the exams, but I do have to admit that in the VC industry, depending on the jurisdiction here in the United States, of course, the SEC, FINRA, and then the regulations, do provide a framework of rules and regulations that bind, then so create a governed industry. There is, of course, also a lobby, which I have to say that I also consider to some degree healthy. It's a way to promote a certain class of interests. So I would like to stress that. I would like that, my experience is, a counsel and, different part of jurisdiction and for both sides. So for the VC firms and also for the companies that, seeking capital. That is, you generally come across very professional and capable, VC firms that, of course, they have the fiduciary, duty to properly deploy the LP's capital. Money. So that's very regulated. And to me, an important innovation that we should consider, we should encourage and support is private clients, so families, high net worth individuals, and also other type of organizations participating in the funding and support of early stage companies, and how this variety mix of institutional capital and private capital together, they can actually objectively bring value. I firmly believe that the addition of these two is more than just the algebraic sum, because there is a very healthy dialogue. I'm, for instance, and then I'll pause and let Megan add, but I'm also very involved in the PPPs, public-private partnerships, and that's kind of, the and it's something that we should maybe reflect and how, PPPs could be brought to VCs. Could we have, and we certainly also already have incubators then work with, VC firms and funders, and together, create, opportunity for funding early stage companies. I'll pause here.
Megan?
Yeah, I guess gosh, I agree with some of your points, and how do I identify? So with regard to the professionalism that's expected, so first of all, there is, the expectations tied to reporting and transparency with regard to LPs, the governance that we take on as our responsibility when we're sitting on boards to advise the founders on. But with regard to fund formation in itself, the checks and balances come into play when fundraising is either successful or not. As somebody raises a fund, typically the institutional investors only really come in when a fund is of a certain size. And at that point, the general partners do need to have some sort of validation and certification in order to be able to manage a certain amount of funds. For smaller funds, we call ourselves emerging managers, funds that are in our first, second, even third iteration, sub 50 million. We're largely raising from non-institutional investors, family offices, high net worth individuals, and we have to keep that level of professionalism and those standards in order to be able to grow and have a multi-generational firm and expand the AUM to ultimately raise from institutions. There's a lot of information shared within the industry about deals, about funds, and it's important to keep everything as buttoned up as possible for the purposes of sustaining one's own fund and business. So it's not formal in the way that, let's say, Daniela's legal degree versus, my MBA, where I got in and did the work and then somehow just left and I was suddenly a master of business administration, says who. But so I would compare it to that.
Yeah, for years, the industry self-labeled as being an apprenticeship guild model, where
Yes.
you learned under the tutelage and guidance of somebody more seasoned and experienced. And there's definitely good VCs out there. But what we've seen, again, having observed the industry for so long, is there's also a massive ebb and flow of who comes in, and if they do well for whatever reason, whether they were lucky or actually skilled, nobody knows. They get to say, "Aren't we smart?" And then firms like Kleiner Perkins go through their own natural life cycle, and we're seeing it happen. I've seen it almost 3 generations now of VCs come and go, and a few of them win. And the consultants will tell you there's a fraction of the individuals occupying venture firms' general partner roles that have skills that's measurable, meaning that they've been able to repeat delivering good value for their investors. That's their customer, is the investors. And those that can actually deliver repeatable alpha, as it's called, repeatable risk-adjusted returns that make it compelling for investors, is just a fraction. And the question is, before the House obviously, is would professionalizing the industry in a more formal way, so that, because ultimately my affinity personally, and this is me, my own op-ed, I've watched the entrepreneurs struggle for funding when the VCs shut down because of their prior bad behavior through typical bubble behavior like we've just gone through. Entrepreneurs are the ones that are victimized by investors' bad decision-making because they get caught up in it. In a FOMO type bubble environment. And the entrepreneurs are the heroes, and the investors willing to support the entrepreneurs are the heroes in entrepreneurial capitalism. The GPs are intermediaries, and funds are intermediaries trying to bring some degree of scale and sustainability. And that's obviously the topic of today's discussion. So anyway. Go ahead.
I agree with you there in the sense that I think there needs to be more transparency all around too. also with the allocators, right? The limited
Oh, yeah.
partners and their intentions in
yeah.
investing in the different funds. So there's it trickles up and down in every which way.
If I may,
Yes.
sorry,
Go ahead,
go
Danilo.
on. I definitely I agree with the transparency should be more transparency, but let's also say let's also remember that the ambiguity, let's say that the nebulous environment is also inherent in a entrepreneur, early stage entrepreneur. So it's like this is we want to have a transparent market, but we also need to remember what are the structural differences between, let's say, a listed company that's going through all the cycle and now is listed, and an early stage, a 3-month venture or 1-year venture that is like working still, like defining the business concept, is trying to build revenues and test markets. All of this is so inherently not transparent. And so I would say I would stress a lot on the aligning of interest. So we want to work as hard as we can to align the interests of the entrepreneur and the VC, and so the capital provider. And this is very dynamic relationship. We, as many agents we have in between, lawyers, counsel, and then placement agents, and of course VC firms there, and each time we have a risk and opportunity to correct the misalignment or to strengthen the problem, to expand the problem, worsen the problem.
Right. You get more intermediaries, more moving parts, more cooks in the kitchen, if you will. You have less efficiency. And that clearly that's what's happened in the public markets, is as they evolved, commission costs collapsed. That stimulated a lot more investment, standardization of investment vehicles. The 40 Act was passed in 1940, the Investment Company Act, that established these standardized structures of mutual funds and now ETFs and what's called closed-end trusts. 40 Act products, they're called. But they really took off as after commissions were dropped, and then the technology infrastructure of what Charles Schwab provided and some of these others really accelerated the velocity of investment activities. Doesn't make it good or bad, but that's something that I think we're talking about in the venture world is, well, the total dollars of venture capital have gone up dramatically. When you just unpack the numbers a little bit, and you see it's largely late stage investing from the hedge funds and the folks that came in late in the party in the last bubble. But the amount of funding going for the earliest stage entrepreneurship is still, it's dwarfed by where investors are putting the money elsewhere. And I think therein lies the opportunity, is to say, what can we do and how can we mobilize more dollars, whether it's institutional money that wants to not just play in the big late stage stuff, but they actually want, BlackRock has talked about this and has Vanguard. How can they, not do they want to, but how, when they want to deploy hundreds of billions of dollars, how can we create more institutionalized structures and processes so that money can flow efficiently? And that solves for a lot of the issues that we all struggle with, is unless you're in New York, Silicon Valley, Boston, LA, and maybe Chicago, where 85% of funding activity happens because of the geographic concentration, because the absence of real institutionalized and standardized processes. It's still the same way as it was in 59. You had to meet the entrepreneur. But what would it take for that not to be the case? And I've got a suggestion, because again, having studied this, the reason that as a securities analyst, I didn't have to meet the managements of Intel or Cisco, they didn't have to parade to my office and pitch me on the company before I bought the stock and put it in the client's portfolios, is because I had access to data. And the reason I had access to data was because of the Securities Act of 1933. It established the first standardized reporting requirements if you wanted to be a publicly traded company. And so this effort at standardization is critical for both risk management and increasing the velocity of investment activities, both. And so that's why I think the standard is critical. Yes, sir.
and while I agree with everything you're saying, Joe, may I also kind of, take us back again to the structural fragmentation that early stage companies bring, and maybe a solution or a support that we're already seeing. I'm seeing, in the negotiation transaction that I'm working on, it comes from technology, blockchain, and all these innovative ways to take a more objective picture of a investing opportunity. So shifting the conversation from the vision, the dream of the entrepreneur, which we have to, at least I have to say that it's still
It's necessary. Oh, it's necessary. Absolutely.
and it's like, however, to bring velocity, to bring quantity of capital, to bring the opportunities from out several geographies. So US to go beyond geographies. Can I invest, in a European VC opportunity?
Why not? Yeah.
Technology may give us some support toward that goal.
I agree with you, but I would lean more on standards versus technology, because there wasn't a lot of technology in the public markets, yet standards did have its intended outcome back way before there was all these modern technologies. Megan, you have some thoughts, and then I want to add to that.
Yeah, I think well, just thinking about if you're applying what you said about investing in Intel in the public market and leveraging data as opposed to meeting the team, I'd be curious what your take is on applying that to early stage, because the early stage, the only data you have is the team. You have their thesis on what's the market problem they're disrupting. You have their attempt at a solution, which is very likely to pivot. But the only thing you have is as a hard data point is the person you're talking to, who is planning to build this business with the capital at hand. And you can craft data points on those people, but it very much is a human capital business. So yes, it's subjective. I think there are ways to mitigate the downfall of this subjective nature of venture, where it becomes, so often a boys' club because of reaching out to people within arm's length distance and getting folks into deals who are pretty much the same as within concentric circles don't really expand that way. But I think there are more and more funds now that are doing a better job at that. There's more data-driven top of funnel initiatives, right? Using AI to cast a wider net in order to source companies so that you have greater pattern recognition based on just sheer volume of deal flow. But in terms of making decisions on the companies themselves and what they can report at the earliest stage, I'm curious your thinking around that.
Yeah, let's address that, because that is where the whole process breaks down and perpetuates itself in this analog world of in-person meeting and boys clubs, cool kids clubs, we'll call it, right?
Cool kids club, yes.
If you're in network, whatever network that is, it could be Cornell alums for all I know, right? Sure. If you're in network, then you've got access. And to me, that's an abomination for the entrepreneur that doesn't have the luxury of being in network. We need, in the most purest form, a meritocratic, objective, standardized way, so that we do eliminate the bias from who gets funding or who can get access to capital, as well as it will build that standardized infrastructure to allow for capital to flow more efficiently. So the very objectives laid out and the intentionality, as Dion pointed out, is that so both entrepreneurs can have a better experience, a broader audience of entrepreneurs, and investors can have a better risk-adjusted return experience. There was and there is a tool that was purpose-built for exactly what you're asking for, Megan. And sadly, it has been forgotten about. It was used by the VCs that were contemporaries of the original architects. And then it was taken to the corporate VC world, where it's been well known and used for 30 years, because corporate VCs are typically less driven by the incentive of swing for the fence with LP's money so I can get a big power outcome. And they have more of a fiduciary expectation to report to the CFO or board of directors what they're doing with shareholders' money in their corporate venture initiatives. And it's called the Bell Mason Diagnostic. And this is something that everybody in the venture industry and angel world should know about, and they don't, principally because they're not required to. This is my pet peeve. Gordon Bell was the inventor of the mini computer and a rock star. He won the first von Neumann Award, which is the Nobel Prize equivalent for technologists. It's Wikipedia as long as your arm. He just died a couple of months ago, but after a heart attack at Digital Equipment Corp, he went out to Silicon Valley and became a mentor for a lot of startups. And he said, these are smart people working on interesting projects, but they don't know how to build a business. There's got to be a way of defining a series of natural logic steps, operational milestones, if you will, that when done in their entirety horizontally, but also in the right sequence, you're going to stand up a business soundly. The marketplace is always going to define whether what you've got is there's an appetite for it, but at least you can have confidence you're de-risking the architecture and the build out of the business. The lean startup canvas was actually lifted out of the Bell Mason around those finding the milestones around finding product market fit, a major risk for any startup. Those were lifted out by Steve Blank. But the Bell Mason diagnostic, as it was taking shape, Coopers and Libran got involved because they also recognized traditional GAAP accounting is an insufficient reporting construct, but there needs to be a standard.
Yeah.
And so they worked with Gordon Bell and Heidi Mason, thus the Bell Mason diagnostic, if it's the right things to do to build the business, it's the right things to do to report on externally in a standardized, objective way.
Sure.
So this has been out there for a very long time. It was created in the late 80s and early 90s. Gordon wrote the first book on how to write a startup, and that's how I got introduced to it. The book came out in 91. But it's, again, been overlooked in part, from my opinion, because of the absence of professional standards in the venture industry. This should have been taught, should have been required reading because it was scientifically designed, architected, back-tested over thousands of companies back when it was first taking shape. And it does represent the very thing you're asking about. It is there, but people don't know it exists. And that's the problem. It shouldn't be a knowledge gap at this stage when the venture industry started in 1959. There's two tax laws around that incentivize and de-risk the after-tax risk and return of venture investing called the QSBS laws. Now, the venture industry had forgotten about those until about 2015 when they only focused on the newest one, QSBS under Section 1202. But the original definition came from a predecessor one that was passed in 1958 called QSBS under Section 1244. These are critically important to know about if you're a fiduciary of other people's money. But most VCs don't, nor do they track it and capture it on the K-1s for their taxable LPs, which is a direct violation of their fiduciary responsibility. Danilo, you've got some thoughts here. And we'll come back to you, Megan.
No, let me say that isn't the Bell Mason diagnostic more on focusing on the valuation? That is a lot. I would say that it primarily addresses the art that we live in now with the setting a certain valuation in an early stage company. So how to move away from the being an art, highly qualitative and subjective assessment, and into a more scientific and
objective and structured, which is what we talked about.
Valuation. But I'll say
it's not just valuation. No, it's also operational steps.
But I think that when an investor, so from a VC firm or a private client, is considering investing in an early stage company, definitely, valuation is a key element of the decision process. Definitely the operation, the architecture is also very important. But let's say that the operation normally an engaged investor is able to address that. If the investor says this is to me a valuable opportunity to invest in, but it's not sufficiently structured, operated, there will be a negotiation there. And in most of the cases, not always, most of the cases, that negotiation is successfully solved. In the valuation, that's a little bit trickier. Then, if the gap remains substantive, of course, there could be a missed opportunity. But this too, and I would say that there is, at least my personal experience tells me that there is a lot of, innovation, and there is a lot of, constructive dialogue. I would encourage and support, like, keep investing in creating multiple types of platforms. So, like, from the incubators, and then, like, the mission-driven platform that bring into the VC world all types of potential investors and funders and companies. Because by democratizing, by expanding, enlarging these two platforms of the equation, capital and creators, my experience it tells me that that is a healthy way of going through and separating the good opportunities and the opportunities that don't get invested.
Megan, you had a lot of, thank you, Danilo. Megan, what were your thoughts? Or do you remember them?
Yeah, I have a few. I guess like I'll pick on the point about the business model canvas just because I was Steve Blank's TA, teaching assistant in grad school at Columbia, and and seeing it being used in real time with all these students, and by all means, excellent for validating that an idea should not be pursued, because it's great for understanding where the holes are, which is really important to do before you go too deep down the rabbit hole. But from an investor's perspective, I wouldn't look at a business model canvas before understanding the team's value to that business. I think founder market fit tends to be even more important at that very early stage. So yes, this is an extremely innovative idea. And yes, everybody you spoke to validated that there is a willingness to pay for it out there somewhere. Mm-hmm. However, can this team get to those people at scale without pouring all of their dollars into Facebook and Google to advertise it?
Well, you're exactly right, Megan. And again, and that's true with, again, I always go back to my securities analyst days, is that we were like a quant shop, right? We had access to great data, what we thought was great data, and our track record suggested as much. And it's actually now taught as part of the CFA curriculum, this unique framework to do fundamental analysis. So I can speak objectively, and there's objective reference points. But what it allowed you to do by having the standardization, looking backwards over a company, you could not care about the headlines and actually see what good execution actually looks like when it's measured in a thorough and a standardized way. So you're looking at fact versus potential.
Right.
And that's a key part of what the Bell Mason does represent is, and it's important to lessen the subjectivity of interpretation. Think Moneyball. It goes back to the whole Moneyball concept. It just proves you can't trust your eyeballs, because we tend to get excited about things we get excited about. We lose objectivity, and data is a better source. And the Bell Mason does represent a structured way to track their performance in the earliest stages. Don't have to have revenue. That's just a natural life cycle stage. So anyway, it's all over Google. I would encourage the audience to do a deep dive on the Bell Mason. It's been used forever. Like I said, corporate VCs that are more process and fiduciary driven, less profit center only driven, carried interest driven. They've been using it for decades and are well aware of it. Yes, Danilo, it does absolutely is relevant to valuation. But valuation in all of these early stage startups is largely what value do you assign the intangible assets on the balance sheet, goodwill, potential. Most startups are still about potential until you get much later stage, which is where so much of the money did flow, because they were looking for a relatively short window to the public market. So I know we're running out of a time. I was looking for questions. We don't have any questions the audience has offered up directly, but we can just stop the conversation and open it up very quickly. See if anybody wants to put forth a question that we might have triggered in your mind. Andrea asked for information on the Bell Mason. It is all over Google. There's a variety of pieces out there on it. I'm proud to say, and what we're doing at Angel Span is that Gordon Bell is an investor in our company, and we licensed the Bell Mason to establish a standardized way to communicate externally. Startups are our customers, so they hire us for their own investor relations. So that's That's a little bit of an advertisement, but it's the Bell Mason I'm intimately familiar with, and it does provide equally as important for on the investor side. It gives the investors more confidence. They're just not hearing this wild-eyed entrepreneur blow blue sky smoke at them. There actually is a structured way to look backwards and objectively calibrate how effective to date, however many years the entrepreneur has been in business, how well are they executing against an objective, standardized, rigorous framework. It does expedite the due diligence, without a doubt. Standardized transparency is the key to fix and bring more sustainability and expand, because the Bell Mason also doesn't care what you look like or where you're located. These are standardized operational milestones that are ubiquitous to business models, CPG, tech, med tech, it doesn't matter. They are all applicable and relevant. So this does allow for and set up a meritocratic objective standard by which entrepreneurs are viewed before they are invested in, versus this in-network cool kids club bro network. It's the hot FOMO technology of the day or whatever, right? Another question from Andrea. It says, I'm trying to understand, do you recommend to use the Bell Mason rather than business model canvas? I'm a former corporate VC. The business model canvas was lifted out of the Bell Mason. So think of it as a subset of the Bell Mason diagnostic. The granular components of the lean startup canvas is that Steve popularized is a subset, a real small subset of the broader Bell Mason diagnostic that addresses 4 key points: the team, the product you're building, the market you're going after, and then your fundamental operations. And each one of those 4 pillars has 3 subcategories, like operations is accounting and legal and fundraising. Those are the subcomponents of operations. And if you apply that lens to FTX, he had no accounting and he had no financial controls, and yet Sequoia chose to invest in him, or really without evidence of transparency or controls. So there's a lot of cautionary tales that can be viewed in the rearview mirror, where the purported smart money was violating fundamental tenets of their fiduciary responsibility of having some semblance of standardized process and risk management. And they rationalize it in 6 ways from Sunday, and then they create bubbles, and then they destroy a lot of capital. I've watched this happen over 3 cycles. Let's see. Another question from Sarah. What are some of the best investors to connect with for farm, ranching, ag acquisition for succession planning? Whew. I have no idea. Anybody else? That's a tough one. That's really specific, and probably more of I would go to talk to your ag banker. They probably know folks that are either customers or buyers, but I would just reverse engineer it from, if it's a family-owned farm, a la her succession planning question, I would reverse engineer it from your neighbors, the bankers that have supported them, and find out to that extent versus trying from a top down. Danilo, you got some thoughts?
I support that. Yes, the reverse engineering is a good process. And now here, without giving any kind of specific advice or any kind of any opportunity, but generally, to me, that is I see that as well addressed through a number of mission-driven platforms. So there are a number of investors that are looking to invest in early stage agrotech, so farming, and just coming with next generation. So working with a company that has gone through, so has track record, and think about now a new generation. How can I extract probably some value, some capital? So the diversity of investing platforms addresses those needs.
Mm-hmm.
Yep.
I threw my email in the chat. I'm happy to, I can think on some folks who have thesis areas in ag tech right now and are particularly active in that space, and share offline.
Super. I hope Sarah heard that and has your email. She's viewing it, not just listening. It's Megan@amplifyventures.com. MEGHAN. The rest is self-explanatory. Well, we're running it right at 1 hour. Why don't you guys offer your last thoughts and wrap up? Let's wrap up here. And again, Megan, you go first.
Oh gosh. Yeah, I think we talked a lot about networks and community relationships, and I just think that being part of this Cornell community I know it's been very beneficial to me in terms of finding great opportunities to invest in and sharing notes on different investments and diligencing them. So I hope that I encourage all of you to leverage it to the best that you can as well.
Danilo.
Very similar. Yes, I encourage all the attendees to keep investing in this opportunity to connect. I mean, VC remains a human, it's a people business, and I think that it's very helpful to think about how we can improve the business, but also get comfortable with this. I would consider healthy tension between not sufficient standardization and optimization, and a healthy degree of tension, of potential conflicts.
Mm-hmm. Okay, one more point too.
You want something else, Megan?
Yeah.
Sure.
For those who are found, we talked with regard to like expectations, professionalism, and standards of investors. As a founder, it's often easy to forget that it's a two-way street in fundraising, right? Like the immediate cash seems more desirable up front than the equity that a founder is giving up. But the reality is that the equity is, presumably going to be worth a lot more in the long run. So be picky about the investors you're inviting onto your cap table as a founder.
Oh yeah. If your entrepreneurs on there, that is the single best advice you've heard. Be very, very, very careful about who you take money from. I would offer it from a systems design thinking, because there is a ton of great research out there that's been done by thoughtful people and triangulated by others where the conclusions were validated with proper statistical analysis, real portfolio data, et cetera, that says the venture industry is ripe for innovation and what I would call professionalization. What is a properly diversified seed stage portfolio to manage what's called non-systematic risk? Most VCs don't even know what non-systematic risk is and how to manage it properly. Systematic risk is the number one risk to manage according to the research. And how do you manage that? You do it through staged capital deployment, what the public markets call dollar cost averaging. And if you're going to invest properly with proper diversification and proper stage capital deployment with objective standardized performance metrics across your holdings, then you need a standardized way that the entrepreneurs communicate, and you can track their performance a la the Bell Mason diagnostic. So at its core, it is a critical component to modernizing the venture process so it becomes more institutionally scalable, and ultimately, with as the title says, becomes more sustainable as opposed to just an ebb and flow, peaks and troughs, boom and bust cycles that ultimately the entrepreneurs, the heroes, get whipsawed by. So that's my last comment. So Renee, you would like to wrap this up?
Yes, thank you. What a terrific discussion. And thank you again, Joe, Megan, and Danilo, for your inspiring thoughts on how we can improve the VC industry to become more sustainable. As a last remark, I would like to invite the audience to stay tuned, as we'll have a new keynote on October 23rd on the role of social sustainability in economic transformation. So stay tuned, and thank you everyone for attending.
Thank you.
Thanks for having me.
Thank you.
Thanks.